What an absolutely crazy start to the week, ladies and gentlemen. We have the market up significantly after some progress was revealed with these China trade talks. We have Tom Lee coming out and outlining an even more bullish thesis for 2025 with also some really important tips for investors here on how to fully capitalize on this year. Now, we're also going to be talking about a very specific scenario of what could start to play out over the next couple of quarters here that I don't think anybody is fully aware of, and it has a lot of really important implications for the market. And as always, we're going to be talking about some of your favorite names, the most relevant pieces of news, and how the charts look in the short term so that you guys can make better decisions in the present here. So guys, before we get into all of that information and roll the Tom Lee clip, if you guys don't mind and you do enjoy the information and analysis I provide for you guys in these videos here, make sure you go down and hit that like button and make sure you're subscribed so you never miss another video like this. And also, massive shout out to all of the members of the Less Trades More Profits trading and investing community. I mean, I'm going to throw up some of the gains, my gain screenshots up from today, right around $14,000. Really awesome start to the week. But again, me making money is great, but seeing all of you coming in and being able to take the lessons that I am teaching you and going out and using the watch list that I provide for you guys every single week in the private live streams, all of the things that you get in there, and going out and making all of this money for yourself is exactly why I started this community in the first place. So remember, for those of you guys that are interested in hopping in there, I'm running the biggest promo that I think I will ever do. It's 50% off your first 2 months with code MAY, link down below. It's literally only $1 a day. If you're interested, we'd love to have you in there. But without further ado, let's roll the Tom Lee clip and start breaking everything down.
It's better to be in the market for a long time than to try to time the market, correct? Like if you're a trader, hedge fund, that's one thing. But if you're a longer term investor with a timeline of more than 5 years, the bias is clearly to the upside. But I think because the sell-off was so politically oriented that it kind of took on a life of its own. Would you agree with that?
Yeah. I mean, there's a couple of factors at work. We were highlighting it during the tariff dislocation, but we know that the equity professional universe of investors, looking at political surveys, more than 60% are Democratic leaning. So their interpretation of the actions of the White House was half empty. So we saw an exaggerated move in equities relative to the bond market, where in the bond market it actually is flipped. In the fixed income world, 60% of bond managers are registered Republicans. And so that's why I think you get better signal, at least in this instance, from what the bond market was doing. And the second is, of course, something people have talked about is the 10 best days. We were highlighting this multiple times that if you exclude the 10 best days of 2023 or the 10 best days of 2024, the S&P only returned 3% a year each of those years. So you need to stay in the market, as you point out, in order to get the 20% gains. And I think this year is another example of people rage sold at 48.35, and now they're buying in today. They missed 1,000 points or 20 percentage points of a gain in 2025.
Do you have any thoughts on kind of bond yields at these levels? Does it matter? I mean, just kind of picking up on what we were just discussing. And for those who missed and wish that they had piled in at the lows now a month ago, what do you say now? That no one now wants to go, all right, fine, I'm going to make my move now, and now stocks are back at the highs. Maybe we then slide lower again. So just some kind of general advice.
Yeah, I've got a couple pieces of advice. I mean, right now, the 10-year yield at 4%, I think isn't a huge burden for not only for the government, but also for the economy or for companies. So I think it's a level of funding that businesses can earn a return on capital. And then as we think about 2026, there's a lot to be excited about. We have deregulation coming. We have the tariff debacle behind us. We have tax cuts possibly. And then we might have better trade partnerships with other countries, meaning U.S. companies have earnings upside. I think that the market is flat year to date through May. So I don't think anyone should feel like they missed anything. I think that they're going to have a chance to buy a lot of companies. A lot of stocks got obliterated. And I think that these washed out names are still opportunities. And we talk about it with our clients, whether it's Tesla or the Mag 7 or the small caps, there's many opportunities still.
Now, one of the most important things that Tom Lee outlined in that interview clip there is that time in the market is always going to be timing the market. Now, that doesn't just apply to whether you are trying to get good entries on your long-term share trades or even some of these mid to long-term position trades, but it also has to do with your approach to the market every single day. obviously we are going to see some significant volatility. We are going to see stock prices go up, go down. We are going to move to the right. If we start moving left, we're going to have some significant problems. But again, things are going to continue to develop. As an investor, you always have to be thinking of a longer term vision and understanding that the outcome of one individual trading day, unless something is drastically changing with your investment thesis, then it really is not going to matter a whole lot in the long term. And again, with everything that we have to look for moving forward, which we are going to start breaking down right now, things are looking very, very, I will say, interesting from a couple of different perspectives. So the first thing that we absolutely have to talk about is Trump says China will open up to US businesses and suspend trade barriers. This is something similar to what we saw in the UK. Remember, the United States businesses were going to have more access to the UK markets here. Now, in addition, they also agreed to pause most tariffs and other trade barriers for 90 days. Some of the details on there, the US agreed to temporarily reduce tariffs on China to 30%, down from 145%. Beijing said it would lower tariffs on US goods to 10% from 125%, and that is really the main reason why the market, we're looking at the S&P 500 futures right now, have significantly moved to the upside. Now, what we also have to think about here is the overall big macro landscape. And you also have to tie into the Fed to this and also the new administration's goals. Now, I think a lot of people, it doesn't necessarily matter your political leanings, whether you're on the right, whether you're in the middle, or whether you're on the left. I think a lot of people were looking at the first quarter of this year from a perspective of this is really a lot of chaos, and we don't necessarily know what this new administration's goals actually are. There was a lot of playing both sides of the fence, and you also had a Fed that was kind of furthering that uncertainty and saying things like, especially last week at the last meeting, that they don't necessarily know what the proper time is going to be right now to start moving on interest rates. Now, what was important about that is that usually uncertainty from a Federal Reserve or a central bank is typically going to lead to downward movements in markets. Now, that's not happening right now, and there's one very specific reason as to why, in my opinion, and I'm going to lay this out for you guys right now. I think what a lot of people have been focusing on, and especially the Federal Reserve, has been the actual initial potential price increase from tariffs here, and potentially seeing that increase in inflation, which is not going to allow them to cut rates. Now, there's also something else developing right now that I don't necessarily think that the Fed is fully focused on, but they're going to have to start focusing in on in the near future, and that is, what if this administration's goals are actually met? What if they are actually successful and we do see some significant tariff revenue coming in, and we do end up seeing some of these interesting developments here too? Will Donald Trump eliminate taxes for Americans earning less than $200,000 per year? Again, we already have seen some developments with this new tax plan, but what I think a lot of people have to start looking towards now is that we are starting to get out of this period of chaos, and what actually happens in the event that this administration is successful in their attempts and we start focusing in on that growth initiative that I've been talking about for a while. So when you combine that with potentially increasing tariff revenues, decreasing taxes, and also these new deregulation efforts, well, you have a potential situation that could massively stimulate growth of United States businesses while also giving consumers an additional amount of disposable income. Now, what is that? It's effectively fiscal stimulus. Now, that is going to increase growth. It's going to increase innovation. It's going to make businesses a lot more competitive. It could potentially, in theory, drive prices lower in some sectors of the economy. But going back to what I said before, if the Fed is going to be very uncertain and the market is not selling off based on that uncertainty, it means that the market is paying attention to something else. And when we come over here and take a look at some of these rate cut probabilities that we've been really focusing in on over the last couple couple of months here to see what the market is actually thinking for movements in the federal funds rate over the next couple of meetings here. Well, again, just looking at that June meeting, well, a month ago, there was a 64% probability of a cut, and now that is down to only 8.1%. In a lot of other different environments, the market would not be taking that positively here. But what the market is starting to think about right now, especially with the announcement of the UK trade deal and additional progress on this China trade development here and these China trade talks, is wow, we might actually have some hope that this administration is going to be successful and can have the ability to meet some of their goals. Now, we do have CPI coming out tomorrow, which is going to give us a little bit more of an insight into consumer prices. But just in general here, when we look at PCE, the Fed's preferred metric of inflation, we are still seeing a significant move to the downside here, getting towards that 2% target. And then I want you to think about growth. So when we think about these rate cuts here, remember, the Fed is just going to be looking at the economic data, and they're really going to try to stay away from trying to guess what the new fiscal policies are going to be from this new administration here. So you actually have potentially a scenario if GDP doesn't end up getting revised, like Besson says here. Besson says U.S. Data not showing a recession, expects Q1 data to be revised upwards. Remember, a lot of these businesses were coming in the first quarter and trying to import a lot of these goods and services to get ahead of a lot of these new tariffs, because we didn't necessarily know what was going to happen next, how big these tariffs were going to be, or how long lasting they were going to kind of stay around for. And this is what Tom Lee is referencing when he talks about some of this deregulation and further progress on these trade deals. This is what Tom Lee is focusing in on, and then tying it back to the title, and that one thing that we always have to focus in on is having that longer term vision, thinking to ourselves, okay, here are the different kind of scenarios that could play out. What are the potential outcomes of those scenarios? So right now, we could easily see these growth initiatives across the market in the overall economy be successful, and that could lead to the Fed really not needing to lower interest rates in the near future, but they probably will at least once this year, even if this new administration is starting to show signs of being successful in a lot of these growth initiatives. But if they aren't, again, we kind of already understand that there's going to be a muted effect on prices here. We aren't necessarily going to see that crazy 8% inflation that some are expecting for this year, as shown by the consumer sentiment data that we have talked about a lot. And you could still see growth slow down. So in that case, the Fed could come out, decrease interest rates, and loosen financial conditions a bit. So overall, we have a very, very interesting backdrop here, kind of going into the next couple of quarters this year with a lot of potentially positive catalysts. Now, I want to start talking some about these individual names here for you guys. Again, the first one that we're going to be talking about is SoFi. So again, we have been talking about SoFi in this potential post-earnings consolidation setup over the last couple of days here, really last couple of weeks, or really since earnings. Now, we did end up seeing that break to the upside today. We hit that first area, that 1390. If we get through that 1450 area here, again, next target's going to be 1489, and then you could easily see if the market holds up, SoFi get all the way up to that $17 area, which would be absolutely awesome to see. Remember, I own this one at $6.55, bought this last July, so very, very solid position for me. And it's also very interesting to see here, JP Morgan increasing their position in SoFi by 476% in the last quarter here. Now, this is actually after they sold 90% of their position the last time that one of these 13Fs came out. So very interesting. They're getting a little bit active in their SoFi position here. They must see something that is very, very much enticing them to get back into SoFi here to be able to capitalize on these next couple of quarters of movement. Now, let's talk a little bit about another retail favorite here, and that is Hims. Hims is up about 6.6% today. Again, not a very bullish look on this chart right now on this daily candle, but they did receive some pretty positive news here off another one of these Trump announcements. Trump signs order aiming to cut some U.S. drug prices to match lower ones abroad with this most favored nation policy here. Now, what this can do is that if a lot of the drugs and pharmaceutical products that Hims Hims is offering become a lot less expensive, well, they could see some significant subscriber growth, additional revenue growth, and again, with Hims already growing at a significant pace, this could easily turbocharge their growth over the next couple of quarters once we start to see the effects of these new policies here. But again, just kind of looking at this chart here, not necessarily one that I would be wanting to enter into now. Again, we were talking about potential longs on this one at the $30 to $31 area. Would I chase this one all the way up at 55? Absolutely not. I would be waiting for a decent pullback on this one, a nice period of consolidation, and a really strong looking long setup in order to want to put more capital at risk in this name here. Because again, when you see stocks move so aggressively to the upside like this, again, what goes up in most cases does end up coming back down, retracing a little bit of the move and finding a little bit of balance. Now, I do want to talk a little bit about Palantir here. Again, the overall market here today, guys, is up significantly, but Palantir is not. One of the things that we've been talking about with this name over the last kind of week and a half here after earnings is that this one is now going to go into a period of finding a balance. It is going to find what the overall market right now is going to deem to be its fair value, even though I may not agree with what Palantir's valuation is out in the marketplace right now. Again, this is one that has incredibly strong fundamentals, very strong growth, commercial revenue growth, government revenue growth, global revenue growth here as well. And this one isn't going anywhere anytime soon. This one, as I've said before, I'll say it again, is going to be held to a higher standard by the market and needs to grow into the valuation that it is currently commanding in the marketplace. Now, the last name that we have to talk about today, ladies and gentlemen, is going to be NIO. So along with a lot of the other China names here, Alibaba, Pinduoduo, off of this China positive trade talk development here, we are seeing a lot of these Chinese names starting to move to the upside. We have a nice breakout on NIO. Remember, we were forecasting this bullish move on NIO up to not kind of the top of this zone here. We did get a little bit above. Again, did kind of deserve here to pull back into the middle of this zone, and now we are seeing that solid break to the upside off of this positive development. Now, very key level here is going to be this recent high here, right around $4.44. And we also have to worry about this 200 exponential moving average level here, where it's currently sitting right around $4.63. Now, while NIO doesn't necessarily have any shocking or crazy news today, we do have something interesting that has occurred with NIO. Remember, NIO stock was recently added to a 30-day positive catalyst watch at Citi. And when you look at the actual trading activity of Citigroup, again, on the 12th, it was announced that NIO, the NIO position that Citigroup was holding was increased by 434% right here. They're currently holding about 7.3 million shares. They are hedging some of those shares here with a put position that they have as well. They did recently trim this put position by about 50%. Now, we also have JP Morgan over here doing something pretty interesting with this one as well. It does look like they are taking a directional bet on NIO here. They trimmed their call position by about 97%. Their put position increased by about 4,800%, in their share position down about 95%. So Citigroup, pretty bullish on NIO. JP Morgan, not bullish on NIO here. But remember, the thesis here, just with NIO in general, has kind of been outlined. They are either able to hit those profitability goals and metrics, or they are not. If they are, this one could be an absolutely massive winner. If they don't, again, that really, really solid risk to reward entry that I have outlined for not only you guys on here, but also in the private community, there really won't be any significant downside from those levels there. So guys, that is going to wrap up this video here. If you guys did enjoy the information and analysis that I provided for you guys in this one, make sure you go down and hit that like button. Costs you nothing to do it, but helps me out a whole lot in spreading this information out to as many people who actually want to learn. And again, if you never want to miss another video like this, make sure you guys are subscribed, turn on notifications so you're notified every time these videos go live. And for those of you guys that are hopping into the LTMP group, we'd love to have you in there. Can't wait to have you guys making some of those gains with us. But until next time, guys, I will see you. Peace.